Friday, January 13th, 2023, Monaco 64, home of alternative economics and contrarian views. So today we're going to look at how the big money, the Wall Street money, is moving into gold and commodities. And it's going to be for many years to come, I would say. Before I start though, yes, today is Friday the 13th. It's related, of course, to the Knights Templars when they were rounded up by the French king back in, I think, 1307, if I'm not mistaken. But with that, I'm going to recommend a really good book about the Templars. And it's called The Templars, The Rise and Fall of God's Holy Warriors by Dan Jones. So he's a great historian, Dan Jones. So I highly recommend that. I've read that before. And I'm actually reading another book by him right now. I'll let you know about it when I finish. Just wanted to let you know that we're going to be doing the questions from last week at the end of the video after the market update. And just wanted to talk a little bit about silver before we go into gold and commodities. I've recently put a bid in for 25 threepence or 3 pence from pre-1920, and there are 925 silver, of course. And there's 25 of them, which is the equivalent of 1.05 ounces. I've been outbid. It's now 30 bid. There's still, let's see, 1 day and 8 hours to go. So I think this pretty much gives a good idea of where the ounce of silver should be. I might put another bid in there, a 31 bid, who knows. I don't want to pay too much for it. But they're great coins to have, I would say. The threepenny bits, they're called. They're like even smaller than a dime. They're about 1.4 grams, the total weight. And then you have to multiply by 0.925. And then you divide that by 31.1035, and you find out how much of an ounce it is, each coin, and then you multiply it by 25. So, back to commodities, back to gold. And again, I don't want to say I told you so, but I've been telling people about this for a couple of years now, even longer. About commodities, and we're starting to see people on Wall Street talk about this, and we're going to go into that in a second. But just wanted to show you here my commodities bull market playlist, and this video is going to be put into that playlist as well. But 2 years ago, I said a new Bretton Woods should favor commodities and emerging markets, right? That's 2 years ago. 5 years ago, I said commodities in the first inning of a major bull market. 4 years ago, are commodities about to hijack Goldilocks? So that was 2019. We saw that definitely last year that happened. It took a few years. And a lot of the stuff I talk about is not like overnight that I think is going to happen. It's over a medium to longer term perspective, excuse me. So you can see here that I've been talking about this for quite a bit. About 3 months ago, I talked about Russia and Saudi Arabia intensify power shift from paper to hard assets. 4 months ago, I said the end of globalization will underpin a major commodity bull market. So there's a guy, of course, many of you have heard of, Zoltan Pozsar from Credit Suisse, the investment bank. Well, it's also a commercial bank in Switzerland, but it's also a big investment bank, and he's based out of New York, out of Wall Street. He used to work for the New York Fed, so he's well-respected analyst, and he's been talking about this now. You kind of wonder if he was watching my videos from 2, 3, 4 years ago, because he calls it Bretton Woods 3. I just said that I called it a new Bretton Woods 2 years ago, that it would entail the BRICS, and that commodities would become a lot more important. So unfortunately, I can't let you have all of this latest newsletter because there's proprietary, how can I say, rules to this. This belongs to Credit Suisse, but someone sent it to me, a good friend, because he's got access to it. And his latest one is from January 6, 2023. It's called War and Peace. And we're not going to go through it. We're going to go through the part which I think is really interesting and important to gold and commodities. It says, I intend my war dispatches as a series. I intended my war dispatches as a series of dispatches that would provide clients of Credit Suisse with a framework to navigate the great power conflict that I think will define the macro and investment landscape this decade. Great power conflict is not a joke. It is quite real. President Xi refers to it as a struggle, a word which he used 22 times at the latest Congress of the Chinese Communist Party. In the West, we tend not to think of what's coming this decade as a struggle, but we should. To that end, I'd suggest reading my war dispatches in this order, right? So, and it's not surprising to me when there is conflict and war. As Greenspan said once, in extremis, gold is the only form of payment, right? Fiat money is not accepted. And also inflation and war go hand in hand. We look at the Revolutionary War in the US. The Continental became worthless. We look at the Civil War. The greenback lost a lot of value. The Confederate dollar as well. And even in the Napoleonic Wars, we saw quite a bit of inflation. During World War I and in the aftermath, we saw hyperinflation. The same thing for World War II. The German currency was obliterated as well, and some other ones in Eastern Europe. And yes, and also maybe pandemics and conflicts. And now, of course, even President Putin a few days ago or a week or so ago said that the war was not just against the Ukraine, but against NATO. We're seeing U.S. Forces in Japan exercise in order to protect Taiwan. So they're starting to saber rattle. Yes, we are in a hot and cold war environment, like Zoltan talks about. But this is where it really gets really interesting here, because he gives all the 5 points: war and peace, war upsets all 4 prices of money, war and interest rates, war is inflationary, war and industrial policy, war means industry, war and commodity encumbrance, and then war and currency statecraft. So he goes on to say, what does this all mean for one's portfolio and the price of various instruments? So this is what I wanted to show you. So number one, 60-40 won't cut it anymore. What does 60-40 mean? Well, that means that the big money, Wall Street money, keeps 60% of its investable assets in stocks and 40% in bonds. So he thinks now it's 20-40, 20-20 instead. And it represents 20% cash, 40% stocks, 20% bonds, and 20% commodities. But the interesting thing is, out of the commodities, he says, commodities should include 3 types of commodities: gold, yellow, black, and white. Yellow is gold, gold is gold bars, black gold is oil, white gold is lithium for EVs. So gold bars, he's talking here to the big money, to the people who have accounts with JP Morgan or the big investment banks. Yes, and I know Credit Suisse is in trouble, but we need to listen to what the big money is doing, and I think that's very important. And I think they're starting to move already. I just saw this yesterday from Rafi Faber. He noted that someone bought some January futures on Comex the other day, and January is not traded right now because it's a live month. It's a spot month. So if you buy a contract in January gold, that means you want to take delivery of the gold. And lo and behold, someone did that with 1,223, or actually 1,149 spot contracts, which was the equivalent of $215 million worth of gold. They just taken delivery of that. So that means the big money is going after gold, just like Zoltan said, and they're going after gold bars, not coins, because yes, if you have hundreds of millions or billions, it's easier to buy the bars, the kilo bars, the 400 ounce bars. And I'll give you a little bit of context to this COMEX operation, because I was a futures and options broker for 20 years. Yes, I did trade some gold and silver futures, but the bulk of my business was government bonds. But I can tell you that JP Morgan, for example, is one of the biggest clearers in these exchanges. I remember a lot of our clients, sometimes they had accounts with JP Morgan, and they had like what's called a execution account with us. They like to talk to, let's say, to me or one of my colleagues, but their account was with JP Morgan. So what they do, they trade through us, and they'd give us their accounts with JP Morgan. I think it was a 5-number account. And a lot of times you could hear people saying, oh, this trade is give up JP Morgan account so and so. So I wouldn't be surprised if this was for one of JP Morgan's big clients, or it could have been one of Credit Suisse's big client. But the other thing I wanted to talk about to do with gold, is that 20%. He said, gold, oil, and lithium. Does that mean that it's going to be a third of 20% is going to be gold, a third in oil, third in lithium? Not necessarily, because he thinks other commodities, as well as you can see here, will be important. But let's say that it is a third of the 20% is gold. That would be 6.66%. And of investable assets, because that's a part of that whole basket of 2040, 2020. And if you compare it to now, the estimate is that investable assets in the precious metals is about 0.5%. So you do the maths. That's 13 times what we have today. At most, I would say it could be less, but even if it's only 5 times, you can see why it's going to be important to have gold bars for those guys. I guess for us, maybe we can have gold bars one day, who knows? But yeah, so I think that's very interesting. And I think the fact that people are buying spot gold contracts like that is very significant, because COMEX is not really known to be a physical market. They try to discourage clients from taking delivery on COMEX, but this must have been a big money client, and they couldn't say, oh, you can't do that, because they'd look stupid. So we need to keep an eye on this, not just for January, but in the future when, let's say in February, the February contract will become the deliverable one. We'll have to keep an eye on this, see how it goes. So with that, let's quickly look at the markets then this morning. It's just gone past 8 a.m. London time. We've got spot gold at $18.98, actually up $1. Yes, yesterday we traded above 1900 in the spot price. I think the high was 01. Overnight is the same. The high has been 01, low has been 92. Silver's down slightly. down about 5 cents at 23.70. High's been 88, the low is 60. And it does seem a bit frustrating that gold is moving up quite nicely and silver seems to be capped around 24. I think it's only a matter of time until silver breaks out. We're seeing that a lot of silver is being drained out of COMEX as well, as you can see here. So you just need to be patient, I would say. Silver's part of that new 20% weighting as well. It's not just gold, oil, and lithium. It's all commodities. Those three, I think, is what Zoltan thinks are the most important ones. Dow futures is down 62. Nasdaq is down 17, and S&P is down 6 points. Fairly quiet. Yes, CPI was in line yesterday. People are talking now that the Fed is only going to do 25 basis points. So it's gone pretty quickly from 70 to 50 to 25. Pretty soon they're going to stop raising rates. I think, they're going to be mistaken because the CPI, or what they call inflation, is going to pick up again maybe later on this year. But they can't afford, of course, to keep raising rates too much. To the currencies, and yesterday was a huge day for the yen. The yen appreciated a lot. The dollar dropped over 3%, and it's continuing today. And the dollar index as well is broken definitively below the high from January 2017, which is 103.82. I spoke about that last Saturday, I think, or last weekend, the fact that there's been a reversal in the dollar index. So let's quickly look at the currencies here. Sterling is down slightly at 122.02. The GDP numbers came out today. They were a little better than expected, but almost at zero GDP growth in the UK. The euro still relatively strong at 108.40. It's down slightly overnight. And the dollars continue to drop versus the yen. It's down 0.5% at 128.53. And remember that it was at 150 until recently. So the yen strengthening quite a bit. Dollar is unchanged versus the yuan at 672.70. Let's quickly check the ruble. The dollar's coming off versus the ruble too. We were at 72 last week. Right now we're at 67.20. Excuse me, down 0.5%. To the other currencies, Aussie dollar is unchanged at 69.67. Dollar is unchanged versus the Canadian, 133.50. And the Kiwi dollar is down a third at 67.37. Let's look at the general commodities. Let's start with platinum. Platinum is unchanged around 1,070. So platinum is kind of consolidating, I would say. It still looks quite positive. To the other commodities here, WTI crude is up 0.25%, almost back up to 79. It's at 78.71. Brent is unchanged at 84. High-grade copper is down 0.5% at 4.18. So let's quickly look at the bond market. 10-year yield has dropped. It's at 3.45. It is unchanged overnight. And also the 2 years dropped quite significantly. We're now down to 4.15. It's also unchanged though. Let's check the gilt market. The 10-year gilt yield is up about 2 basis points at 3.35. The 30-year is up 3 as well at 3.72. So to the questions, quickly go through these questions here from last week. And we're going to do the last 5, I think. Yep. Number 10. This is what would happen in a deflationary collapse. Can we get a rough estimate of when you think all this could occur? It's hard to be floating in limbo knowing something will happen at some point makes it difficult to commit to anything with no idea as to when this all will be happening. Robert Costello. Well, these are like probabilities of things that could happen, and because I think there could be also a hyperinflationary collapse. I think the most important thing to know is that things are not normal. We're not in the 60-40 world anymore, just like the guy from Credit Suisse said. So yeah, I can't tell you when this is all gonna occur. I don't have a crystal ball, but the trend is for that. So you need to do your own due diligence and your own thinking through. Number 11, this is from the old guy, and it's again for that deflationary collapse video. Great points, thank you. It makes us think in the code, the propaganda, the Keynesian logic of employment aside. If industry increases, so they need more employees, they need to borrow to pay salaries, to buy more raw materials, energy, and manufacture. Eventually they get paid and hopefully either pay off the debt or roll it over and buy more raw materials. Does this not increase the money supply, bank money? The increase in salaries is more an argument to keep the middle class from growing and ignores productivity flowing to the general population. So I think he's asking whether we can have a deflationary collapse if they're increasing the money supply. Well, I think my point here was that if they raise rates too far, it could lead to a deflationary collapse. It could lead to companies having to close down and lay off people. I hope I answered that, that question. Number 12 from Deborah Legoretta. This would have, deflationary collapse video. These are all the deflationary collapse video. She says, you're assuming, like every gold bug invariably does, that gold will remain liquid in a deflationary collapse. Why would it? Well, let's go back to the last big deflationary collapse. That was right after the stock market crash in 1929. By 1933, when FDR was inaugurated, there were massive bank runs in the US. There was a deflationary collapse. What did the FDR do? And back then, don't forget, bank runs meant that you were taking your dollar bills and taking your gold out of the bank, right? So what did the FDR do? Well, it was such a bad collapse that he made it illegal to get gold, to have your gold, because who wanted the gold? Well, the bankers needed the gold, or else they would have gone out of business. And what did the FDR do by January 1934? Well, he revalued the price of gold. So yes, gold and silver are the only money left, because in the deflationary collapse, nobody wants the currency. Everyone is rushing to get real money. So that's how I would answer that, Deborah. Number 13 from DA. How could derivatives implode? Well, derivatives could implode through volatility, because all these derivatives are highly leveraged and they're off balance sheet and people don't know what's going on, especially in the over-the-counter kind, which don't publish public information like the futures exchanges. So for example, if you get a 5-10% move in one day the wrong way in a derivative, you get a margin call, and if you can't cover the margin, then the whole system could implode, just like in the '08 crisis and the Lehman collapse. I recommend you watch The Big Short, and you understand. Yes, they're usually highly leveraged derivatives. Last question here from Ricky Talk. How is national security arranged in an Austrian school economy? Well, the Austrian school is to do with economy, not statecraft, I would say. But national security would be, even under the Austrian school, if you ask von Mises, he would say, well, it's the king or the president, it's the state that runs national security. They run the army, the navy, and the other armed forces, and they protect the borders. That's how national security works. But I would say the Austrians would be isolationists, because they wouldn't want war. They want peace and prosperity and sound money. But yes, you would still have the armed forces to protect the borders of the country. So there you go. With that, I wish you a good Friday the 13th. Take care. Bye.